Okay, let's unpack this. We are about to witness the end of, well, one of the greatest eras in modern financial history.
No exaggeration there.
After decades of being the singular defining figure of global investing, Warren Buffett, the Oracle of Omaha, is finally stepping down.
It's hard to even imagine, really.
He's retiring at the end of the year at the impressive age of 95 from his role as CEO of Berkshire Hathaway.
And we are not talking about some small fund here.
Not at all.
We are talking about a $1 trillion plus company, a massive non-tech rarity that just defines stability in a volatile market. The sheer weight of that legacy is staggering.
It absolutely is. And for you, the shareholder, or maybe the curious observer, or just someone trying to understand these market shifts, the immediate question is completely valid.
Which is?
What happens to a company that has been synonymous with one genius for nearly 60 years?
Right.
When you invest in Berkshire, you have fundamentally been investing in Buffett's brain.
His capital allocation, his judgment.
Yeah.
Exactly. His judgment and his reputation. So our mission today is to do a deep dive into the research and determine two things. First, can this highly decentralized entity continue its market-crushing trajectory without its founder?
And second, once the official transfer happens, does the stock remain a good, reliable, long-term buy?
That's it. And the answer, as we'll see, it really lies in the institutional scaffolding that Buffett spent decades building.
Okay, so let's start with the immediate certainty then, the successor. It all centers around Greg Abel.
Right.
Abel is the definitive key figure now. We have the timeline. He steps into the CEO role at the start of 2026. And while this transition plan has been public since 2021, Buffett's official retirement date just makes the handover feel so imminent, unavoidable.
And what's critical to understand here is that Buffett's tenure was so long, so deliberate, that it allowed for a succession plan that really prioritized continuity over disruption.
He wasn't just finding a replacement.
No, he was ensuring cultural permanence. This is where we really need to define the Berkshire culture, because that's the real asset here.
Okay.
When the late Charlie Munger, Buffett's essential partner, gave his endorsement, he said that with Abel as CEO, the company would be able to keep the culture. And this isn't just about, being friendly. It's about governance.
So what does that culture actually entail? What are we talking about?
It means three things, primarily. First, extreme capital discipline, only buying businesses at attractive valuations and focusing relentlessly on cash flow.
Okay, makes sense.
Second, total autonomy for the subsidiary CEOs. Buffett famously ran a $1 trillion empire with a shockingly small headquarters staff.
Right, he gave them complete freedom.
He avoided micromanagement like the plague. And third, a refusal to engage in common market tactics like stock splits, which reinforces the idea that they are building value for long-term partners, not for quick traders.
So Abel's main job is to protect that whole model.
That's his primary job. But, we cannot ignore the worry. Buffett didn't just meet expectations. He consistently crushed the S&P 500 for decades.
He really did.
And the market rewarded that performance with a kind of stewardship premium. Shareholders are, I think, rightly concerned that the next CEO, no matter how capable, won't be able to generate those same market-beating returns.
Just because they aren't Warren Buffett.
Simply because they're not Warren Buffett.
And that brings us directly to the core anxiety in the market, the CEO-centric risk. We know when investors get nervous about a CEO leaving, they worry the stock's valuation is built purely on the individual's, personality and reputation.
Right, not the underlying business.
Exactly. The source material draws a really sharp comparison to the tech world. The strongest modern example is Tesla's Elon Musk. The argument goes that if you take Musk out of the equation tomorrow, Tesla's valuation, which relies so heavily on his personal vision and, cult of innovation, could sink drastically overnight.
I think that's a fair assessment.
So does Berkshire, despite all its differences, face a similar existential one-man show risk.
Institutionally, the answer is a pretty resounding no.
Yep.
Berkshire is fundamentally shielded from that kind of personality-driven collapse. It's not focused on rapid disruptive innovation or driven by daily public pronouncement.
It's more calculated.
Its character is calculated and steady rather than aggressive. It's a machine designed to generate and allocate cash, not create the next iPhone.
I see.
The comparison that provides the most comfort is actually another tech behemoth that faced a similar transition, though under very different circumstances. Apple after Steve Jobs.
Okay.
Jobs definitely had that Musk-like aura, the irreplaceable visionary. When he passed away in 2011, the market widely predicted stagnation, if not decline.
Yeah, it's a good analogy for the institutional shock, but let me challenge that a little. Jobs was replaced by Tim Cook, who was an operational and supply chain genius, right?
Yes, exactly.
Abel, while he has a reputation for operational excellence, I mean, he ran the giant Berkshire Hathaway energy division, he's also recognized as a genuine capital allocator. He's been in charge of a massive business unit for years. Doesn't that make him more than just an operations guy?
That's an excellent point, and it moves Abel way beyond the placeholder narrative. Cook stabilized Apple. He focused on financial engineering, like massive stock buybacks and leveraging services growth. He transformed it from a hardware innovator into a reliable profit machine.
And it worked.
Oh, it worked.
Yeah.
Since 2011, Apple has reached a market cap of $4 trillion, second only to NVIDIA at its peak. It succeeded because the structure Jobs built was just that robust.
Okay.
But, to your point, Abel comes into this role with a much deeper proven track record in allocating capital within a diverse portfolio, specifically in regulated industries.
So he isn't learning on the job.
He isn't learning the capital allocation ropes. He's practiced them. This reinforces the idea that Buffett didn't just pick a steady hand. He picked a manager whose experience reflected the decentralized model itself.
I see.
The structure ensures that if Abel falters, the underlying businesses, Geico, BNSF Railway, the energy companies, they don't just suddenly stop functioning. They run themselves, just as Buffett always intended.
So the key takeaway for you, the listener, is that you are investing in a robust, institutionally protected business.
One that's been preparing for this for decades.
Right, rather than a venture that's dependent on one leader's daily vision. The groundwork laid by Buffett means that Musk-like overnight risk is essentially mitigated.
Precisely. And this is why the change in leadership doesn't just manage risk. It actively presents opportunities.
Okay.
We need to shift gears and look purely at the financial case, because the uncertainty surrounding the departure of a legend often masks some fundamental financial strengths.
Let's talk numbers then, specifically the valuation metrics, because if the institutional strength is there, the stock should arguably be trading higher than it is today.
It absolutely should, and that's where the opportunity lies. Berkshire currently trades at approximately 16 times its trailing earnings.
16 times.
Now, if you compare that to the average of the S&P 500, which is hovering around, what, 26 times trailing earnings,
Yep.
see a massive discount.
Wow, okay. So that 16x valuation suggests that the market is pricing in the loss of Buffett's unique touch, that stewardship premium you mentioned.
It does.
But it also suggests the stock is significantly cheap compared to its peers. Why else would the market allow that, that 10-point spread to exist?
It exists partly because of the perceived risk of succession, but also because of the sheer scale and the composition of the current portfolio.
Okay.
If you look at what drives potential improvement, it's the massive entrenched positions in slow-growing companies.
Right.
Buffett famously bought what he loved and, held onto it indefinitely. This means Berkshire holds immense long-term positions in mature legacy brands. Think of giants like Coca-Cola or Kraft Heinz.
Stable cash cows.
Stable cash cows, exactly. But they offer minimal growth potential in today's environment compared to, say, AI or cloud computing. They drag down the overall growth rate.
So a shakeup at the top might actually be what the portfolio needs to realize better returns. Abel doesn't have the same emotional attachment to these holdings that Buffett does.
Exactly. The new leadership has an opportunity to modernize or refine some of these long-held positions to generate better returns. But this is where Abel faces his first massive strategic challenge.
What's that?
The elephant in the room is not just the portfolio holdings, it's the cash itself.
The cash hoard.
An astronomical amount of cash reserves. We're talking hundreds of billions. Buffett, the master elephant hunter, struggled in recent years to find large, attractively priced acquisitions that would move the needle for a trillion-dollar company.
So he just sat on it.
He's often content to sit on the cash and wait for the perfect moment.
Right.
Abel's approach to this cash hoard will define his tenure. Does he continue to wait for massive, perfect deals, or does he become more systematic and perhaps more aggressive in share buybacks or smaller, more frequent acquisitions in faster-growing sectors?
And that flexibility is an opportunity.
It's an opportunity for improved future performance that the current 16x valuation doesn't yet account for.
That makes the financial case really compelling. You have a highly stable business that trades at a massive discount to the general market, and it now has a new, proven manager who has both the opportunity and the mandate to address legacy issues in the portfolio and potentially optimize the cash allocation strategy.
All the pieces are there.
It looks like a strong long-term buy.
I think the case is strong.
So let's quickly consolidate what we've gained in this deep dive. The core findings really confirm that the institutional risk surrounding Buffett's retirement is strongly mitigated. First, the succession plan is long established, and cultural continuity is essentially guaranteed, reinforced by that decentralized structure and Munger's endorsement of Abel.
That's cute.
Second, the fear of the stock collapsing without the visionary, that Musk risk, is just inappropriate for Berkshire.
Right.
The better analogy is Apple after Jobs, which showed that institutional strength and operational excellence can lead to continued world-beating success even after the founder is gone.
A great historical precedent.
And finally, the stock currently appears to be a strong buy, trading at just 16 times trailing earnings, a substantial discount compared to the overall market average of 26 times. The financials just reinforce the stability of the whole structure.
They offer a clear margin of safety.
So that brings us back to the ultimate challenge facing Greg Abel.
Right. The tension in the next decade of Berkshire Hathaway's story is this. He must honor Munger's expectation to keep the culture.
Which means maintaining the capital discipline and autonomy.
The bedrock of it all. But to earn the market's trust and justify the stock's growth, he also has to demonstrate that he is not simply a passive caretaker.
He can't just be a placeholder.
No. He must explore the opportunities for improvement, specifically by addressing the vast cash reserves and those slower growth legacy holdings like Kraft and Coca-Cola. The question for you, the long-term investor, is how Abel will successfully navigate that delicate balance between fidelity to the iconic past and the aggressive drive needed for better, faster future returns. That is the pivot point for this new era.